If you're planning to enroll in a health savings account with an HSA qualified health plan, and you also see an option for a limited purpose flexible spending account, or LPFSA, well then this is really exciting. It's like when Batman found Robin, or when Mario found Luigi, or when Lucy met Ricky. Yep, HSA plus LPFSA is the most iconic duo in all of benefits. And I'm here to explain exactly how this powerful pair can help you unlock unbelievable tax savings. So let's dive in. First, let's talk about what an LPFSA is. An LPFSA is a great workplace benefit that lets you use tax-free money to pay for eligible dental and vision expenses. It's a special fund just for your dental and vision needs. And not just for your personal dental and vision needs, but also expenses for your family too. And because the money is tax-free, you end up saving around 20% on whatever goes into the account. Now, of course, this depends on your personal tax rate and specific tax situation, but that's money that would have gone to the IRS. So you're essentially maximizing your purchasing power through tax savings on eligible expenses. And there are tons of LPFSA eligible expenses, like eye exams, eyeglasses, contacts, LASIK surgery, routine teeth cleaning, dental work like root canals and fillings, even orthodontics like braces or clear aligners. You can view our list of LPFSA eligible expenses at healthequity.com/QME. So that's what an LPFSA is used for. But how does it work? Well, you elect an amount to put into the account. Then each paycheck, you'll see an LPFSA deduction to cover a portion of the amount you elected. Over the course of the plan year, you can spend the money in the account as needed. There's one huge caveat, however. LPFSAs are use it or lose it accounts. In other words, LPFSA funds eventually expire, unlike a health savings account, or HSA, which is yours to keep every year and never expires. LPFSAs do have deadlines, though there are some exceptions. For example, some employers will offer a grace period extension, or even let you carry over unspent funds into the next plan year. And we'll dive deeper into this later. The bottom line, though, is unspent LPFSA money does eventually expire. So that means it's very important to plan ahead. Now, one more thing that's super special about the LPFSA is that it pairs with an HSA. By IRS rules, you can't have a traditional healthcare FSA along with an HSA plan. So if you switch from a healthcare FSA to an HSA plan and your healthcare FSA still has available funds, again, more on this later, then your healthcare FSA will be automatically converted to a limited purpose FSA with whatever unused funds are still available. And this is only if your employer sets up the plan this way. But the point is, you can either elect an LPFSA during annual enrollment, or in some cases, your healthcare FSA is automatically converted to an LPFSA for the next plan year. Okay, that's the LPFSA overview. And I know we covered a lot already, so now let's go through all of this step by step and talk about how and why the LPFSA makes a perfect companion for your HSA. First, to make it all make sense, we need to do a little HSA primer. If you watched our other HSA videos, which we'll link in the description box below, you might remember that an HSA is the only account with a triple tax advantage. That means tax-free contributions, tax-free account growth, and tax-free spending on HSA-qualified expenses. Now, very importantly, HSA-qualified expenses include medical expenses as well as dental and vision expenses. So you might notice there's some overlap there. And maybe you're asking, why do you need an LPFSA for dental and vision expenses when you can just as easily use your HSA for the same purpose? Well, there are two main reasons you may choose to combine an HSA and an LPFSA. First, an LPFSA essentially lets you increase your total tax-advantaged contributions. You can contribute the IRS maximum to your HSA. Sidebar, you can view the latest IRS contribution benefits at healthequity.com/learn. And then, along with contributing the maximum to your HSA, you can also contribute to your LPFSA. This helps maximize the value of your HSA since you can contribute the HSA max and save more for healthcare expenses and emergencies without needing to use that safety net on routine dental and vision expenses, because you'll have the LPFSA available for that. The second reason you might choose to pair an LPFSA with an HSA is because your HSA lets you invest the money in your account tax-free. With an HSA, you never pay taxes on potential investment growth. So the strategy some members use is this. They make their HSA contributions as usual. Then they invest their HSA to try to capitalize on long-term investment growth. Because think about it. It's not a good idea to invest money that you might need in the near future. So therefore, folks invest their HSA and leave it alone. And then they contribute to an LPFSA to cover expected dental and vision expenses. In this way, the LPFSA lets you maximize the value of your HSA through tax-free investing. So whether you simply want to maximize your contributions or maximize your long-term HSA investment growth, the LPFSA is a great tool to help make that happen. Now, there are several other things to consider if you're deciding to elect both benefits. To start, you also have to sign up for an LPFSA during your employer's designated enrollment period. This is at the same time you'll need to also elect an HSA-qualified health plan, because you can't have an HSA or an LPFSA without being enrolled in an HSA-qualified health plan. Now, if you choose to elect an LPFSA, you'll also have to decide at that time how much you want to contribute to the account for the plan year. And there are a couple of important things to consider with this, so stick with me. Once you make your election, you can't change it without a qualifying life event. A qualifying life event is a major change in your life that allows you to make changes to your benefits outside of the regular enrollment period. And examples might include getting married or having a baby, maybe a spouse losing their health coverage, or even moving to a new area. Qualifying life event rules may vary by employer, however, so be sure to always review your plan details carefully. In any case, the point is that usually when you lock in your LPFSA election amount, it's set for the whole plan year. With an HSA, by contrast, IRS rules allow you to change or update your contributions anytime without a qualifying life event. Now, some employers, however, might have restrictions on this, especially when it comes to changing payroll deductions. So again, be sure to double-check your plan details. Either way, these rules make it so important to plan ahead with your LPFSA. Since you lose whatever you don't spend, you'll only want to contribute enough to cover expected dental and vision expenses. You don't want to overcontribute because that risks losing money, which nobody wants. Now, the really cool thing here is that you'll get your entire election amount on the first day of the plan year. So if you have a big eligible expense early in the year, it's all good. You can count on the money being available in your LPFSA right away, even though your contributions are spread out over the entire year. Now, let's say you have a lot of expected LPFSA eligible expenses. Well, because LPFSAs are tax-free, the IRS limits how much you can put into the account. To see the latest LPFSA contribution limits, be sure to bookmark our enrollment center at healthequity.com/learn. Okay, so to quickly recap, as you consider how much to elect, keep in mind how much you plan to spend, keep in mind contribution limits, and then keep in mind your specific plan details. Because remember what I said? Many employers offer plan arrangements that give your LPFSA a little more flexibility. So be sure to check first if you have, for example, a grace period available. A grace period is extra time at the end of the plan year that you're given to spend down remaining unused LPFSA funds. So if your plan year officially ends December 31st, your employer may let you still spend LPFSA money all the way through February in the following year. This grace period extension varies, so be sure to double-check your plan details. Or your employer may instead offer what's called an LPFSA carryover. A carryover lets you keep a portion of unspent LPFSA funds into the next plan year. You basically get an entire extra year to spend unused funds, up to the plan's specified limit. Now, this option creates a nice little cushion in case you don't actually spend as much as you expected. Now, carryover amounts do vary, however, so same thing. Be sure to double check your plan details and carryover amounts for your plan. All right, now finally, let's talk for just a moment about spending your LPFSA. And this is the best part, right? And unlike an HSA, you definitely need to spend your LPFSA. And in most cases, you'll get a card from Health Equity, which makes it super easy to spend at the pharmacy or doctor's office, or really any point of sale where debit cards are accepted. However, if you don't bring your Health Equity card, no problem. You can pay out of pocket with your personal debit card or credit card, and then simply log into your online or mobile account and upload a picture of your receipt for reimbursement. Now, when paying out of pocket, it's super important to keep receipts because IRS rules are very strict about record keeping for this benefit. No receipt, no reimbursement. In fact, keeping receipts for all eligible expenses is really important in case we request documentation to validate those expenses. With either option, though, spending your LPFSA is super convenient. Health Equity makes it so easy to get great tax savings without breaking a sweat. Discover more about limited purpose flexible spending accounts and visit healthequity.com/learn.